Good morning. You're watching Daybreak on Bloomberg Quint Live, and I'm Alex Matthew. First, the headlines. Asian shares trade mixed after Wall Street carved out slight gains overnight. Firmer oil prices took center stage for investors. Fortis Healthcare's net loss widened as the healthcare chain writes off more than 800 crores attributed to goodwill and intercorporate deposits. Life Insurance Corporation, or LIC, may eventually hold 51% in IDBI Bank by infusing fresh capital, but will not be permitted any management control. That's a Bloomberg Quint exclusive. And in its financial stability report, the RBI projects that non-performing assets in banks could cross 12% by March 2019, and those banks that are under prompt corrective action could have bad loans of as much as 22% of their assets. Let's turn to the international markets now, and US stocks edged higher on Tuesday. That's a bit of a relief after escalating trade fears drove the biggest pullback in the S&P and Nasdaq since April. Bloomberg's Abigail Doolittle has this report.
Stocks finished higher in Tuesday's Wall Street session. A small recovery from Monday's sell-off. The Dow climbed by about 0.1%. The S&P 500 rose close to 0.2%. The tech-heavy Nasdaq outperformed, up about 0.4%. Now, the real tailwind for the markets on Tuesday, oil. Oil was up more than 3%. This helped energy take the top spot among the S&P 500 sectors, up more than 1%. Some of the top names there included Exxon, Chevron, Hess, and many, many others. Another winning sector on the day, though not surprisingly with the outperformance from the Nasdaq, the tech sector, which was up 0.4%. Not a huge gain there, and not a big recovery from the sell-off on Monday, but nonetheless a movement in the right direction driven by the likes of Apple, Microsoft, and Facebook. We also had some of the other big internet names climbing higher in the day from the consumer discretionary space, including Amazon and Netflix. Now, to the downside, the worst sector, consumer staples, not a huge decline there, but some of the drags included both Campbell's Soup and Conagra on continued speculation about the possibility of deals in the food space. And then finally, the financial sector, one of the other sectors that was down on the day, doing something it's never done before, dropping for a 12th day in a row. This as the 10-year yield continues to stay below 3%. In New York, Abigail Doolittle, Bloomberg News.
All right, and just a quick check on the headline numbers with regard to the Asian markets, and we'll come back with a more detailed look at what's happening there. But the early risers, I'm talking about the Nikkei, the Kospi, and of course the Australian benchmark had all were trading lower, but right now they've a couple of them have actually no, sorry, I'm so sorry about that. The Australian benchmark and the Kospi were trading higher, and they've now slipped a little bit in the red. The Nikkei is trading about 0.4% in the red, and we'll tell you a little bit about what is happening in China in just a short while. But before we do, let's go to Darshan Mehta for the trade setup for the day in India. Morning, Darshan. How's it looking at the start of the day?
See, at this point of time, the SGX Nifty is indicating a stable outlook. It's down 15 points. It's recovered slightly from the lows of the day. But nevertheless, most of the Asian markets are trading with a slight weakness. So you're seeing the 10,000. You're seeing that we are coming in close to the 10,700 mark in trade. Yesterday there was this big bounce back that we saw on the Nifty itself. Now, how did the ADRs pan out in trade? Most of them ended with a negative bias. Tata Motors, again, weakness continues. Again, weakness continues in Dr. Reddy's. ICICI Bank and HDFC Bank were flat in trade. Which were the ADRs that managed to gain? Wipro and Infosys on the IT pack, and Vedanta, because of the move that we saw here, saw a rally that came into trade. Now, as far as the Nifty was concerned, the Nifty managed to inch back and come close into the green. That was not the case with the mid cap. The small caps are selling to the tune of almost 1% in trade. Now, if you're looking at the Nifty Bank was down 8 points, and the Nifty PSU Bank was also rather weak in trade. So overall, it was a weak trading session. The FMCG was one of the best performing indices. It was up almost 1%. The indices that didn't do well was the energy index as well as the real estate index, which continues to bleed. Now, as far as the month-to-date performance is concerned, pharma clearly continues to do well, and IT to a certain extent has done well. They have managed to outperform the benchmark indices. The high beta counters, infra, real estate, the small cap, all of them falling in significantly, close to 6.5%. Now, what's been the performance this week itself? It's been just 2 trading sessions, but IT stocks have been in focus, the MNC stocks have been in focus, and the FMCG stocks have been in focus. They've been doing well for themselves, but selling pressure continues on the real estate, PSU Bank, and energy index. They've been down anywhere between 2 to 2.5% this week itself. Now, these are the counters that have come into the 52-week high category. Astral Poly does well. Bajaj Finance was already there. Bharat Financial has been doing well. And along with Bharat Financial, you have IndusInd Bank. Yesterday, the big mover was Hexaware, which moved up. And Tata LIC and Godrej Consumer continue to do well. As far as 52-week lows are concerned, some of the prominent names include, some of the PSUs like Bank of Baroda, Bank of India, Bharat Electronics. You have Motherson Sumi, India Bulls Real Estate. So some of the marquee names are there at a 52-week low. NBCC and most famous is Tata Motors, which has given up most of the gains over the past few days. Now, as far as flows are concerned, FI sold in 538 crores, DIs bought in 238 crores. Overall, if you're looking at it, 11,000 crores of net buying by the DIs this month, indicating it's a liquidity-driven market that is solely driven by the domestic money. As far as the other points are concerned, is the WIX. The WIX was up almost 1.7%, indicating that the market was rather flat in trade. What contributed? HDFC, TCS, and ITC contributed. Reliance over the past few days has been contributing negatively, and so has Tata Motors and ICICI Bank. Now, how did the Nifty and the Bank Nifty pan out as far as futures are concerned? So there was a little bit of short covering that was seen on the Nifty. Open interest was down 10% on the June series. You have the Bank Nifty, which saw open interest decline of almost 13%, and a little bit of long unwinding was seen. Remember, tomorrow the expiry is there. Now, yesterday what happened was that put writers became more aggressive at the 10,700, given the fact that we came close to the 10,700 mark and rebounded from there. Call writers had to shed positions in open interest. Now only 2 days to go for the expiry. Where are positions taken? Most likely it is seen that the expiry will happen in and around between the 10,700 and 10,800 mark, because 10,700 seems to be the big support that the market is having at this point of time. Now, counters in the FNO band, Dewan Housing, JP Associates, Infibeam, all these counters continue to be in the FNO band. You have counters like Power Grid, IDBI, and Wokhart. Jain Irrigation is new in the FNO band, so it comes in the FNO band. It was down 1.6% in trade. The PCR moved up for the Nifty, given the fact that the market moved up, but not with the Bank Nifty. The Bank Nifty was down in trade, and the Nifty Bank PCR moved from 0.89 to 0.80. So that's the trend that we're seeing. Stock specific, Hexaware saw short covering. Open interest was down almost 6%. Fresh longs were seen. As far as the other counters are concerned, there was Adani Enterprises, which also saw short covering that came into itself. It was up almost 2% in trade. IDBI Bank saw long unwinding. Open interest was down 16%. And the last stock I want to point out is Tata Motors at a fresh 52-week low. Long unwinding was seen. Open interest was down almost 22%.
Okay, thanks so much for that, Darshan, about how the markets are likely to pan out in India this morning. Just a quick snapshot. I did talk about this very briefly. The Asian markets, the 3 early risers had, 2 of them had opened positive, and now all 3 of them are trading in the red, but just about barely for the Kospi and for the Australian benchmark. They're trading flat at the moment. The Nikkei continues to trade a little weak, down about 0.3%. The Chinese benchmarks are open for trade, and so is the Hang Seng. And they're trading just about positive in early trade as of now. But let's shift to commodities, where all the action seems to be as of now. And Jayesh Khinnani is here to tell you all about that. Morning, Jayesh. How's it looking?
Morning, Alex. But within the commodity space also, oil is in particular focus. That is because overnight we saw a 3.6% surge in the WTI price and has now crossed above the $70 per barrel mark. Now, this is on the back of API, which is likely to report inventory drop of more than 9 million barrels, which will be the most since 2016. That's the big news that's coming in. Also, we understand a couple of other factors which are playing out for the oil markets. One is there is oil standard, oil sand has upgraded, and there is tension in the Libya price, which has also pushed the prices higher. The other factor that could play out is that US has actually pressured the allies to cut ties with Iran imports by November. So that is also aiding the oil prices on the upward side. As far as brokerages are concerned, we have one note from BNP Paribas which says that Brent could actually trade above $80 per barrel until 2019. So those are some of the cues that we are picking up as far as oil markets are concerned. If you look at the base metal space, the index itself closed lower. However, base metals did manage to close mixed. Now, zinc actually continued its downward slide after entering a bear market yesterday. Also, this is on the back of demand-supply concerns that have been rising. We also understand that the net speculation positions on copper, those have actually reduced by the in the last week. Lastly, we have gold prices which actually dropped to a 6-month low as traders have now increased their bearish bets. Back to you.
All right. Thanks so much for that, Jayesh. Now, a lot of watchers of the Reserve Bank of India and the banking space in India watch out for the financial stability report for the commentary that the central bank gives with regard to the health of the banking space. And the RBI has warned that bad debt at Indian banks is set to climb to a near 2-decade high in this current financial year. In its financial stability report, the central bank also said that public sector banks are more prone to frauds. Vishwanath Nair sums up all the key takeaways from that report.
The RBI's Financial Stability Report, a report which looks at how banks have performed and how they will be performing in the coming year based on certain estimates, points out that the banking system's gross NPA ratio could worsen up to 12.2% by March 2019 from about 11.6% back in March 2018. Of course, this estimate is based on a baseline, a base case scenario wherein the current macroeconomic conditions should continue for the rest of the financial year, and thereby these estimates would change if there are any changes within the macroeconomic space. What the RBI points out in its report is that if the macroeconomic conditions were to worsen, then for the banking system, the overall gross NPA ratio could be as bad as 13.3%, which is considerably high. Talking about the capital position of the banks, and because that is important in reference to the stress on bank books, the capital position of the banks could worsen up to 12.8%, the capital adequacy ratio for the banking system. This number currently, as of March 2018, stands at about 13.5%. Again, this is based on a base case scenario. On a worst case basis, the capital adequacy ratio for the banking system could drop up to 11.5%. Remember that this number is very close to about the 11.25% that the RBI requires these banks to maintain under the Basel III norms. The RBI, as part of a study, also looked at banks which are under prompt corrective action and those outside of the prompt corrective action framework, and how they have performed over the year and how their performance is likely to pan out over the next financial year. In its study, the RBI points out that banks which are under PCA and who have considerable restrictions on the way they can use the capital, on the kind of companies that they can lend to, and on the kind of expansion plans that they can implement, these PCA banks could see their capital base reduced to 6.5% by March 2019 from about 10.8% in March 18. For banks outside the PCA framework, again, the performance could worsen. It could reach, the capital adequacy ratio could reach up to 10.6% by the end of this financial year from 12% currently. Again, these two numbers are on the basis of a base case scenario, which means that if the macroeconomic conditions could worsen over the current financial year, we could see these numbers worsen further. In its report, the RBI also pointed out that the insolvency and bankruptcy framework was progressing adequately, and that banks were utilizing it more to deal with the stress on their books. Overall, while the rate of operational creditors filing cases is high, the cases filed by financial creditors have also been increasing, which shows that banks largely in India are using the insolvency and bankruptcy framework to ensure that the stress on their book is adequately dealt with.
All right, sticking with the banking space and speaking about a big story, in fact, we are hearing from sources that Life Insurance Corporation may indeed pick up 51% stake in IDBI Bank. And Ridhima Saxena, who's broken that story and who's got the exclusive, has all the details there. Ridhima, we're hearing that it's going to be a complicated structure. How much money is actually going to be infused, and what is that structure likely to be? Why is it so complicated?
So let's take you to the main feature of the IDBI Bank Life Insurance Corporation deal, in which IDBI Bank will issue fresh equity, thus allowing Life Insurance Corporation of India to infuse fresh capital into the lender. Also, for LIC, this ownership would mean no preferential rights or management control in the bank. Let us look at the present shareholding as of May. The government had infused 7,881 crore rupees worth of capital through recapitalization bonds to get an 86% shareholding in the bank, which left LIC at 8% and the public shareholding at 6%. Now, let's take the possible scenarios that can happen in this case for IDBI Bank to issue fresh equity and get the capital infusion. In the first case, if LIC invests up to 13,000 crore at the current market price, it will have a shareholding of 40% in the bank, which means that the government shareholding would then come up to 56%, allowing direct control of the government on the bank's board, and the public shareholding will therefore go down proportionately to 4% after fresh equity issue from the bank. In the second case, however, which is more likely to happen, Life Insurance Corporation of India will own a majority stake of 51% at a cost of 21,000 crore at the current market price, which then brings the government shareholding to 47% and the public shareholding to just 2%. Now, the point to note over here is also that LIC will not have any veto power in the bank's management decisions, even if it holds a controlling stake of 51%. This is mainly because of the IRDAI's norms, which require, and also the LIC Act, which require the life insurer to not invest in a bank more than the 15% limit. So going ahead with that, LIC will also have to cut its stake down to 15% over a period of time, sticking to those norms. Also, as per SEBI guidelines, it will be required to pare its stake to a minimum public shareholding of 25% over the next 3 years. So what we are essentially looking at is a board-run entity in the name of IDBI Bank, in which LIC will not have much of a management control.
All right, but when it comes to the process, if this does indeed come to pass, Ridhima, it's not just the insurance regulator. The deal needs approvals from several regulators. How is that going to work?
Yes, so there will be a three-layered regulatory approval cycle that this deal will have to go through. The first one that we talked about would be from IRDA's side. The second and third would be from the market regulator SEBI's side, which will have to make an exemption for LIC to make an open offer, which happens in the case of a change in control of an entity. In this case, since LIC won't have any management rights or controlling rights in the board of the bank, it will mean that LIC may get waived off from that particular condition. Also, an approval would be required from the banking regulator, which is the Reserve Bank of India, for the deal to go through. There will, however, be no requirement of a parliamentary nod, as under the IDBI Act of 2003, a special resolution passed by the shareholders through a postal ballot would be enough to bring the shareholding of the government to below 51% level.
All right, thanks so much for that, Ridhima. We'll stick with that story. Of course, that story is on the website. For all the details that Ridhima just spoke about, you can log on to the website and check out the story on the website about the deal to have infusion of capital into IDBI Bank by LIC. Let's move on now. Fortis Healthcare has finally come out with its quarterly earnings. And while the healthcare giant has taken a one-time write-off of more than 800 crore rupees, the board has also decided to take legal action on some of the inter-corporate deposits that were cleared earlier by the previous management. Darshan's back to take you through all of the details. Darshan, long time coming.
Yeah, so basically they've declared the fourth quarter numbers also yesterday after a long time of delay. Basically what has happened is that revenues are down 3%, the EBITDA is down 11%, but more importantly the net loss is significant. It's a 932 crore net loss that they've done this time around compared to a 68 crore loss that they had last time around, and this is because of a lot of exceptional setup they have done. They have written off some of the part of the goodwill, and there was a lot of issues as far as the intercorporate deposits were concerned, which were also written off. So because of this, this expanded to 932 crores of net loss that happened. The debt, however, is increased. The debt is at 1400 crores compared to almost 1279 crores last time around. But more importantly, it's the commentary from the management and what happened in the investigation report. First of all, what the management said, that they have submitted the investigation report to SEBI as well as the Serious Fraud Investigation Office. They are saying that they have initiated the legal action against recovery of these outstanding ICDs. So they have written off almost 800 crores as far as all these ICDs are concerned. They have made provisions in the unaudited financial results, which we've seen, and that is why the loss was much higher this time around. And they're saying that they are undertaking and they're appointing an external agency to scrutinize all the internal controls of the company, and they're changing a little bit of the internal organization. More importantly, what was part of the key highlights of the investigation report, they're saying that that report clearly shows that there were systematic lapses on the intercorporate deposit grants that were given this time around. They are saying initially the grants were given on without the permission of the board, and from the first quarter FY17 they were done on a rollover mechanism. They are saying that initially they were repaid by checks, but initially the next ones that were coming in they were released at the start of the succeeding quarters. ICDs were utilized by the borrower companies for granting of loans related to parties of the promoter. So clearly there are some lapses that are there. Management personnel and other personnel involved were forced to undertake the ICD transaction, so there was coercion there. They are saying there was a loan given to the promoters to repay some of the corporate deposits that they had, and they are saying that there was significant amount of fluctuations in the net asset value of foreign investment. So overall there seems to be, the investigation also seems to suggest that there were misuse of the ICD provisions that were clearly there by the board of Fortis Healthcare. Now the next step is obviously on Thursday, when we'll come to know the bids. That is the final day of the bids, where the 4 bidders which have been shortlisted will be submitting their bids.
All right, thanks so much for that, Darshan. And of course, again, all the details that Darshan just spoke about are available on the website in the form of a story. You'll see it on your screen as of now. All right, let's head across to another interesting piece of information. Ahead of the first-year anniversary of the Goods and Services Tax legislation, CBIC Chief Vanaja Sarna believes that the challenge for the authorities lies in being one step ahead of tax evaders. Here's a slice of that conversation that she had with Bloomberg Quint's Nikunj Ori.
This is not a new phenomenon. Even pre-GST, there was evasion. So the question is how well you can block it. The view is that the GST system itself will help you and will ensure that there is less of that than there was before.
Could you share some interesting insights with us when it comes to enforcement measures? Do you still think evasion is taking place, and if yes, how?
See, evasion will always take place because that's the way trade is built. Particularly those who were not in the fray earlier, who were actually not taxed at all, or who were taxed but were always evading, it would continue to want to do the same even now. So I think it's difficult to put a finger on exactly what kind of cases, but I would say that evaders will be evaders, whichever way you build it, they will try to beat the system. The question here is, are you one step ahead, and can you make sure that you nab them?
Okay,
and
so are you one step ahead, ma'am?
I would think my DG GST intelligence, and I'm sure the state authorities as well, are all, it's a question of time of how efficient you become in your enforcement activity. You have so much of data available now, so it's no longer, you're not relying like the olden days on human resources giving you some information. That still continues, but you've got a lot of valuable data which through analysis, and we have a DG analytics and risk management, which is actually tasked with this job of doing it. So I think this is just something which is work in progress. As you keep making these cases, you hone your skills and you get better and better.
So, ma'am, can it be said that for the next year, the government's target would be more enforcement measures when it comes to catching or getting hold of evaders? Since initially you had gone slow because that was obviously the right thing to do.
Let me not say that that would be like a target, but it is part of our job. We have an entire setup to do this. We have an intelligence wing to do it. We have an analytics wing that will supply information to help do it. So we have everything in place as far as the environment is concerned or the milieu is concerned for doing this. So definitely enforcement is something, and as you start looking at the returns and as you start doing your auditing, naturally things will emerge, and therefore definitely it will be a step up from what we were doing till now.
And how would GSTN help you in bringing in these enforcement measures?
GSTN is hugely important because it's housing all the data, and our reliance on GSTN is basically for all the data to come to us. And using that and doing the analysis within the department will definitely produce results.
All right, let's head across now to Shraddha Babla for the stocks in news. That is all the stocks that are likely to move and trade on account of being in the news. Shraddha, morning. What do you have for us today?
Good morning, Alex. Manpasan Beverages is at the top of my list. The stock has slid significantly after the auditor raised concerns. So today, the company will report the fourth quarter numbers, so watch out for that one. According to a Mint report, Mindtree's founders could possibly sell stake to Japan's NEC Corp and another PE firm. So you have co-founders K. Natarajan, Subroto Bagchi and NS Parthasarathy, who collectively own 8.3% stake in the company. The overall promoter shareholding in the company is at about 13.3%. So Mindtree is another stock to watch out for. Infosys will provide banking solution to Santander in UK. You have Tata Communications, which is partnered with data center solutions company EdgeConneX. You also have Care Ratings, where in a bulk deal yesterday, Dhando India Zero Fee Fund Offshore acquired 2 lakh shares. That's about 0.7% stake in the company. Then you also have Shalby Limited, the hospital chain operator, which will meet SBI Life Insurance company today, and you also have Shriram City Union Finance, which will meet Ambit Capital and some other investors for the rest of this week over 27th to 29th of June. So watch out for some of those names as well.
All right, thanks so much for that, Shraddha. Now, the fact that you're up this early in the morning and watching this show, you probably didn't catch the last games in the World Cup. If you think that the team that you support is going to win the World Cup, I had a few people commenting yesterday saying that England would win. Let me know what you think in the comment section below. For now, let's talk about the stories that you'll find on the website bloombergquint.com if you log on. First up, here's good news for salaried employees who've been contributing to the Employees Provident Fund. The EPFO has decided to give its members an option to withdraw 75% of their funds after 1 month of unemployment. And further, members would also have the option to withdraw the remaining 25% of their funds and go for final settlement of the account after completion of 2 months of unemployment under the new provision in the Employee Provident Fund scheme of 1952. That provides a sense of security. Now, the central government has decided to discontinue overtime allowance given to its employees after, except operational staff, according to an order that was issued by the Personnel Ministry. The order didn't come out of the blue. It was actually recommended in the 7th Pay Commission. That's all we have for you on this edition of Daybreak, but all you need to know is up next, so do stay tuned. This is Bloomberg Quint.